So, short-term interest rate moved a lot in the last 6 months, and they'll probably still go a bit higher and stay there. Consumer took a lot of debt. Interest rates went up. Consumer was resilient, and that was a sort of our thesis last year, that corporate and consumers are very resilient. But as the time progresses, they're less and less resilient. So we do think that we will have a recession. The question is whether it's a mild or less mild, both here in the U.S. and in Europe. So sort of as the time passes, we think that fundamentals are deteriorating, and the market has been moving up, so that has to clash at some point.
Yeah, it feels almost like investors just are hoping that things won't be as bad. The recession will be mild. We've heard that time and time again from CEOs at this point saying, you know what, we don't see things as being that bad. It's almost like people want to be lazy long at this point. I mean, how would you characterize the market action yourself?
It's a little bit like that. So there's a little bit of sort of a technical move higher, like the trend followers started covering shorts, adding some longs. Volatility, VIX declined a lot, below 20. So declining VIX usually brings some inflows, some systematic, some discretionary. Then people start believing in narratives that things will be better. We have a China, which gives a little bit of a sentiment. Dollar is weaker. So I think that created this narrative that kind of worse is behind us. Kind of recession is over, or recession happened somehow magically last year, and now we're about to grow, which we don't agree. We see actually, if you look at all of these data like ISM, the regional surveys like Empire, Philly, Richmond, they're all kind of going lower. So for me, question is, what's going to make this survey turn up? These data points turn up, and I don't see that happening unless Fed cuts. And Fed doesn't have an intention to cut now, so I do think things have to get worse before they get better.
So the VIX, I'm puzzled at a 20 VIX here. So I hear you on that. But you often cite investor positioning. You guys are great at this. And to me, there's a lot of cash out there. There's also, if you look at the economy, and this is a different metric, but you've got 2.6 trillion in new China savings that suddenly could get unleashed.
No, that's what makes it tough, right? Because positioning is not that high, and that's a bullish argument, And that's an argument that we kind of used extensively last year and didn't kind of save us. Position was low already in June, July last year, and we still went to lows, But I agree, if on a positive side, positioning is not that high, and I think it makes it difficult. That's why it makes it painful, and market kind of drifts higher, because there is a little bit of that positioning pain or ability to re-rate as the volatility comes down, But overall, we do think the direction of economy is south. And at some point that will have to, corporate CEO may say like things look fine now, but are they going to be fine in 3, 6, or 9 months? And market should look a little bit ahead of that.
Marco, what's the math around earnings for this? I think Mike Wilson, his low end's 180. You're starting to see more and more people ratchet down their S&P 500 numbers. What are yours?
So, look, we are at 205. It's a tricky, right? So we are at 205, which sort of prices in mild recession, right? So now if there is no recession, which, again, we don't think that that's the case, but if there's no recession, it's probably 225, 230. If there is a recession, it could be more along what Mike is saying. Could be another, 10% lower, so call it 180, 190. So we're sort of in between, so very mild recession, that's what we're pricing in. Now, we can be wrong both ways. It can be worse or it can be a bit better if we avoid recession. But we do think it's 200 and then 205, and then multiple is a little bit high now, given that the Fed is still moving higher.
It doesn't sound like your PE matches with what you foresee for the economy, though. I mean, if you say the 205 reflects a mild recession, and the indicators that you take a look at indicate that everything's going to go south even more, that doesn't say to me mild.
Yeah, you're right. So that's why what we are projecting, and it is a little bit convoluted. So we think things first turn south, get much worse, then Fed quickly cuts. Or reacts or signals cutting, and that basically inflects us higher. So we still are hoping that there's going to be some backstop in the So when you look at all these data kind of rolling off, if they're left unchecked at 5% plus interest rates, it will be much worse, more along the lines what some of our competitors are saying. But we think at some point they'll backstop it. So the big question is where is it? 3,600, 3,400, 3,200, sort of, we don't have a very strong conviction, but we do think lower is the direction.
Right.
Marco, when you think of your 205 S&P for this year, I mean, think about these large multinationals make up a big part of that, right? And so right now we're waiting for Microsoft's guidance right here. And so what are the incentives, especially with the dollar that you just mentioned that's so weak, and that was one of the reasons why they warned, let's say, 6 to 9 months ago. Do they have any incentives, these major companies, just to inch it out, like quarter by quarter, rather than just kind of take big cuts?
So that could be a path that basically we just gradually deflate, get rid of some of the excesses. The dollar stays a tailwind at these lower levels. So that's this sort of a soft landing scenario whereby consumer can kind of, still survive next, call it 6 to 12 months. It's possible. It's a risk to our base case scenario. I happen to think that, there is usually some contagion or something that happens unexpected. One thing leads to another, and market a little bit kind of front runs all of those developments. So I think it's less likely that you have this type of very soft, gradual, range-bound market until we are ready to rally, let's say in 2024. So it's possible. In that case, we are not going to be right.
But fundamental to your turnaround is the idea that the Fed will flinch.
In some way,
ultimately, the
yes.
Fed will just back down and give in to the markets.
That's what my view. And again, you remember, 475 or 5 or 525. I don't think there's too much of a difference actually. But last time we had this type of rates were in 2007. And then they went to zero after that, right? So I just don't think that 5% rate, we can have this economy functioning in the financial markets and all the changes that happen in the markets, be it leverage in the markets, be it private asset classes, ventures, venture capital, private equity, all those things. I don't think they can coexist at 5% long term. So I think something will have to give and Fed will need to flinch.